Hello, my fellow traders. Alright, in this episode, I'm going to talk about the ever so famous topic of shorting. Okay, everyone loves to talk about it, everyone loves to know about, what shorting is, how to do it, why I don't exactly short too often. So, I'm going to cover all of that in this episode right now. First off, if you're coming into this video and you think that shorting is illegal or has ever been illegal, then I definitely advise you to stop this video and go check out, more of my introductory resources. Okay. I've for some reason seen a lot of people that think that shorting is illegal and that the SEC deemed it illegal because for some time even and you can't blame them because even investopedia.com, the central hub for people of finance and trading in the stock market, and even they had an article for a while talking about how shorting is illegal. So how is the average individual or the retail investor supposed to know otherwise? But in general, I just want to tell you, in no way is shorting illegal. It has never been illegal and it will never be illegal. Okay, there's a lot of misconceptions about it. So I'm just gonna first talk about what exactly it is, how to do it, and then finally talk about my thoughts about it. So starting off, shorting is pretty much another style of investing or trading, and pretty much involves the process of going long, which is, the concept everyone knows of, buy low, sell high, but you do it in reverse. So essentially what you do is you're selling high and you're buying low. It's the same concept, but you're just reversing the sequence of events. So now the way this happens though is that first you sell shares of a stock. Now technically what you're doing is you're selling something that you don't have. But the way you do that is that through your brokerage platform, so whichever one you're using, SureTrader, TD Ameritrade, ShareBuilder, whichever one is your brokerage firm or platform of choice, through that there'll be a order that you can put in that involves or that will discuss, selling to short. All right, and basically that's you're borrowing shares from the broker and you're selling it. So technically you have a position when you sell to short, and so you have to remember that you're looking at the ask column of the level 2 because you're looking to sell it first. And then you're hoping, all right, or the way that you make profit is if the stock price goes down, because now basically you have a loan out with your brokerage firm. Okay, because you sold shares that you didn't own because you borrowed them from your brokerage, and now you have to buy them back to return them. And so you're hoping that the stock price goes down so that you can buy it and then give it back to the broker. And so what you do is you bid to cover, or you buy to cover. So when you short to sell and you buy to cover. And that's how that works, okay? Now, the reason it's a little complicated is, first of all, a lot of people have trouble with that concept, okay? The concept of, first selling something that you don't have and then you have to buy it back. But really, once you become a little bit more familiar with trading, it's not too much of an issue, and you'll see all it depends on is making, putting several orders. And as you become more familiar and get more comfortable with the trading strategies that I teach in my VIP membership, or that I even discuss in my other episodes or in my free videos on my site www.inpennystock.com, you'll see that once you understand how stocks go up and when they're about to shoot up, you'll also start to get a fundamental understanding of when they're about to go down or when they're about to crash. For example, at the end of a pump and dump, or as your analysis skills of level 2 get better, you'll be able to understand when a penny stock is just crashing and when it would be a good short. However, there's a whole nother side that you need to look at before you start shorting, and that is the potential risk that shorting has. Okay, so let me explain that. When you go long, alright, when you're doing the traditional buy low, sell high, you buy the shares first, sell them for a higher price. The only risk that you ever have is the amount of money that you put into the stock. So if you buy $2,000 worth of Fannie Mae, all right, the worst thing that can happen if you're completely, dumb technically, and you go against everything and you never sell and the stock crashes, and the worst thing that can happen is you lose your money. All right, the $2,000 investment goes to zero. That's the worst thing that can happen. Okay, with my methodologies and strategies, you won't ever lose more than about $50. Okay, but or depending on your bank account, you won't ever lose more than 1 cent per share or 2 cents per share. But in general, that's the worst thing that can happen, right? Now, what happens when you short though is you have to understand the ability for a stock to go on to any price. All right, so it is possible that a stock goes up to infinity, all right, or goes up to several $1,000s or $100 or anything. But what you have to keep in mind is, even though it's not likely, the risk is a lot more higher, because when you sell to short, okay, you're selling something that you don't own, and now you have to buy back the shares, but you don't know what price you have to buy back the shares at. So if I sell a penny stock to short it at $2, I'm hoping that the price goes down and I can buy it back cheaper, and I basically just got a discount, and that's where I make my profit. But it's possible for that $2 stock to go up to $40, $50. Does it happen often? No. Has it happened? Yes, it has happened. Penny stocks have ran like crazy. They have ran up thousands and thousands of percent. Okay, Plug has been one of those cases where it started off at $1 and ran to $10. Okay, in just a matter of a few weeks, and it ran even higher than that. Okay, so the problem with shorting though is that if you don't properly adjust your risk level and you don't learn the fundamentals of how to cut your losses short, or cut your losses, sorry, no pun intended, cut your losses, then you potentially could owe your broker a lot of money, an unlimited amount of money, because you have to buy back those shares, and those shares could have gone from $2 that you sold it at to $50, and now you have to pay your broker back each and every share at that $50 amount. Okay, and that's not the worst part about it. That's a limitation though, but if you start getting some sense and some discipline and some trading strategies and knowing when to cut your losses, that doesn't become an issue for you anymore. Okay, and your intermediate traders, you're probably like, okay, well, what's the problem? Now let me tell you the other problem of why I don't preach this method and why I don't even use it. Okay, I try to be as newbie friendly as possible. I try to appeal to new traders. That's where I found that people need the most help, because the big guys like Timothy Sykes and Superman, they're concerned with their own things. They're concerned with their top end clients who are paying them the trading challenge for Timothy Sykes is about $6,000, and Superman has his boot camp, which I'm sure has a similar cost. And what happens though is that the new traders get screwed. The new traders, who don't even fully understand the stock market, who don't even know exactly what shares are, who have never, used a trading platform before, there's no one that can teach them how to properly trade. So usually those people also tend to have smaller accounts, which is wise of them, because, you shouldn't throw all your money in something that you're not, fully comfortable with. You should slowly grow your account or invest more in your account as you see that you're becoming more and more profitable. So the other aspect of shorting is that due to a SEC, Securities Exchange and Commission rule, so everyone in the United States is has to worry about this rule. It's called the $2.50 rule. All right, and when you short a stock, you're gonna be placed with a liability of at least $2.50 per share. So in terms of your buying power. So it's a little complicated, but let me try to give you guys an example, okay? Say you have $2,500, okay? $2,500. Or you know what? Let's make this even easier. Let's make this very simple. Say you have $10. $10 in your account, okay? You buy a share for, a stock is $1. So you have $10 total in your account. The stock is going at $1. If you buy it, you only lose $1. You invest $1. So you can buy 10 shares of that, right? Because you have a $10 account. Each share is $1, so you can have 10 shares. All right, basic multiplication. With shorting and the $2.50 rule, you're only allowed to get 4 of those shares. Even though when you short it, you're only selling and getting $4 back, the brokerage firm needs to protect their investment. They need to have an insurance policy towards your trading, and because again, like I was talking about before, there's an unlimited risk. The price could go up thousands of dollars, or it could go up dramatically, and then you might not be able to pay back your broker, and then you have your own issues monetarily, but the broker still needs to get the money for the shares because they sold you shares that weren't yours when you were shorting. So they still need to protect themselves, and so they instituted this $2.50 rule. So not only are there all the other complications that you have to worry about, but then there's also this restriction that gets put on your buying power whenever you try and short. So that one, you might want to short that $1 stock, but you have to keep in mind that you'll only be able to short 4 shares of that, not 10 shares. Okay? Because of the fact that your account only has a total of $10, and the 250 rule, meaning 250 times 4 is $10, meaning you can only short 4 of those shares. I hope that wasn't too complicated. Again, I can clarify it for you guys. You might want to re-listen to it. I know it's a little confusing, but in general, those are the reasons why I don't short. Okay. Also because I'm trying to appeal to new traders, and new traders definitely should not even think about shorting because it's a lot more complex. There's a lot more rules, there's a lot more volatility, and a lot more risk. Okay, penny stock trading is risky as it is. All right, I try to teach you the ways to make it the least amount of risk. I try to bring it down to very, very little and minimal, de minimis amounts of risk. So that's why I don't promote shorting at all, and I probably never will, to be honest. Okay, unless I change my niche. I sometimes do it myself, but I will never recommend other people to do it unless they themselves are advanced enough to feel that they can try it out. But if you do want to try it out, do it in a virtual trading account. Okay, get familiar with it like all other trading strategies and everything that I recommend. Before you decide to try something new, make sure that it works while you're doing your virtual trading, and only then should you carry it out into your real trading strategies and your day-to-day trading. So I hope that helps. That's my whole take on shorting. Again, it's not illegal. If anyone says it's illegal, you clearly know that they don't know what they're talking about, and it's not even worth arguing with people like that. So yeah, I hope that helps, and I hope you guys now have a more fundamental understanding of shorting. So I'll see you guys in the next video.